Your guide to mortgage points explained. Okay, so today we're going to be talking about mortgage points, why you as a potential home buyer, maybe someone who already owns a home and is thinking of refinancing, why it's critical that you understand A, what these are, and B, how they work. Now, first of all, there's two different types of points that a lender can charge. One is called an origination point. What that means is that they're charging you a percentage of the loan in order to be the lender. So sometimes you'll see lenders charge 1 point origination, which means 1% of the loan amount. So if your loan amount's $200,000, they're charging $2,000 to do your loan. There's other times I'll see a loan summary and I'll see that a lender is charging 2 or 3 points in lender origination. That is not normal, okay? I can't tell you guys enough. That is not normal. So definitely keep an eye out for that. Generally with lenders, you're gonna see for their fees, they're either gonna charge underwriting, processing, a loan origination point, or they'll charge a lender fee. So for instance, where I work at Guaranteed Rate, as I film this, our lender fee is $16.40 regardless of what the loan amount is. And that's on all loans except for VA because we waive our lender fee on VA. So as a potential buyer or refinancer, the first thing you always want to ask a lender is, what are your fees? Because you want to know if they're going to charge you a mortgage origination point or if it's multiple points or if they have a flat fee, okay? Now, let's talk about discount points because that's really what I think you need to pay attention to. Yes, you need to pay attention to lender fees, but discount points are where I see the biggest problem in the industries right now. And as I film this, it is May 2024. And I've been seeing this for years, but it's just even worse now. I was recently looking at a loan summary that was sent to me. We're always happy to review your loan summaries. And I asked the buyer, I looked at it and I was like, there's $15,000 in points. It was a $500,000 loan. They were paying 3 discount points for the rate. I'm like, hey, yeah, this is really high because you're paying 3 discount points. What are those? Right? That's the thing. So what's happening right now is that buyers are not being educated on what points are or how they work, and lenders are quoting rate without explaining to you the cost of that rate. So what is a discount point? A discount point is supposed to be a way to buy a below market rate. So I am making up numbers here. Okay, let's say that the interest rate on a 30-year fixed for your scenario, conventional loan is like 6.75, okay, at par. Par means that the lender's not giving you any lender credits, but they're also not charging you any discount points for that rate. Now let's say that you want 6.5, and 6.5 costs 1 point. Okay, so 1 point is 1% of the loan amount. So if you're doing a $500,000 loan, 1 point is $5,000. Now, what a lot of people go is, wait, how many can I buy? No, guys, don't do that, please. So with points, there's always a calculation to make sure a lender doesn't tip over tolerance. But the bigger thing is, it's not how many can I buy, how low can I go? It is, does the math work, right? And that's what so many people are not paying attention to. So 1 discount point costs 1% of the loan amount. Now the next question is, well, Jen, if I can buy a discount point and I can lower the rate 1%, great. Yeah, that would be awesome. That's not how it works, okay? Buying 1 point never equates to a set number. It changes daily. Yes, when I first got into mortgages, I had such trouble with this because I was like, well, wait a second. If it's 1 point, why wouldn't that get you down 1%? Like, it did not make sense. But what I'm telling you is that when lenders are looking at rate sheets, we have the rates, but we also have what's known as the margins. And the margins are where we determine how much we would have to charge to get each rate. those margins change daily based on investor appetite, the market, what the company is feeling about a certain rate. When they go to sell loans, do they have enough at XYZ rate? There's so much that goes into the margins that it's never consistent. So if, for instance, let's say we're on the phone today and you're like, okay, Jen, where would 1 point get me? And I'm like, oh, okay, like it would get you to 6.5 today. Making up numbers. And you're like, great. And I'm like, okay, do you want to lock? No, I don't want to lock. Okay. So you call back the next day and you're like, okay, where does 1 point get me today? And I'm like, 6.625. Wait, what? It was 6.5. Guys, it changes with the market. So that's the most important concept to get, is that points change with the market. So 1 point is always 1% of the loan amount, but how much it buys down the rate is going to change daily. So for instance, when I'm quoting a client, I am always trying to do it with no points. And the reason I do that is because otherwise, A, it's far too convoluted. B, it's not consistent. C, you're just going to have an upset client because, the concept that this changes and that 1 point doesn't have a set percentage it buys out, it's really frustrating. Okay. So the big concern beyond that is that what I'm seeing in the industry is buyers don't understand they're being charged points. And often they're being charged points and it's not really lowering their rate. They may be working with a lender that has really high rates, right? Because remember, all lenders do not have the same rates. Not even all lenders at the same company have same rates. When you're thinking about interest rates, you've got what the company is trying to make, what the lender's trying to make, and then you have what you get from it, okay? So it's important that you recognize, well, wait a second, if I buy 2 points from XYZ company, I may actually get a better rate from ABC company if I bought the same amount of points, because it's going to depend on A, what their par rate was, but then B, what their margins look like. Yeah, I know. You guys are like, oh, Jennifer, this is a tough video. It is, but here's the thing. If you're going to be spending, 1% of the loan amount when the average home in America is over $500,000, like, yeah, you got to learn this stuff because this is a lot of money we're talking about. Now, the other thing I see happening is I see loan officers where they will try to sell you as many points as possible. Now, as a loan officer, do I make more money by selling you points? No, it doesn't affect my pay. Whether I sell you points or I don't sell you points, my pay is the same. But some lenders really push points and they do it for a multitude of reasons. Number one, if you're buying that rate down, they may be able to max qualify you for more. So what that means is that with the lower rate, what you qualify to buy could be more, okay? We see a lot of this, generally it's not the buyer directing it as much as it may be a real estate agent that says to the loan officer, hey, I really need you to get them up to 550. How can we get there? And the lender goes, oh, well, if we get the rate to here, then we can do this, okay? Would I personally ever buy 3 points? No, I definitely, no. Based on what I see in the rate sheets, I don't see a benefit to it. So when I'm looking at points with my clients, what I'm doing is I'm making sure the math works. So whenever we're talking about a buy down, and it doesn't have to be a full point, it may be half a point or a quarter of a point or 1.5 points, I'm sketching out, hey, this is how many months it's going to take in order for this to mathematically make sense. And when I say mathematically make sense, it's basically a gamble. It's like this. Okay, if you pay XYZ, it's going to take 2 years for this to make sense. And what that means is that if you keep the loan for 2 years and you do not refinance, then your money is going to start breaking even after that 2 years. However, if you refinance before that 2-year period, all you've done is light your money on fire, okay? And I go through that because I don't want you guys lighting money on fire. So it's something that whenever you're talking about discount points, you really want to make sure you're working with a lender who's taking the time to tell you, when they're quoting rates, what's the rate with no points? What's the rate with a point, whatever you want. I'm generally going to go no points unless I'm looking at that rate sheet and I see a good opportunity. But you want to be able to have these conversations. Also, what we'll see is like, a new build, right? And on a new build, they have this big incentive they're trying to spend. So they're buying all these points. And with certain loans, that doesn't even make sense. Like with VA, you can actually use any seller credit to pay down debt within a limit, right? So that would make more sense than buying points, but the lender's just going directly to points because that's all they know. So the key thing about it is this. Number one, if any lender is charging you points and you're the one that finds it and they never talk to you about it, leave them, okay? We are talking about serious money. Number two, 1 point is 1% of the loan amount. How much that buys down your rate changes every single day with the margins. 3, the math needs to be done. Do the math. You need to see if you're buying down the rate, how long it makes sense for that to break even so that you know, like, okay, like, do I really think rates aren't going to go down in 2 years? Sometimes I've done the math for people who have brought loan summaries to us and I'm like, this is going to take 6 years to pay off. Like, we had one that was really appalling. It was a 30-year loan and it was going to take 35 years to break even. Like, it made zero sense. And that's the thing is that as a buyer, as a potential person refinancing, you're trusting that the lender is going to have your best interest at heart. Not always. I mean, look, there's a lot of lenders out there that just want to close you. And they know that if they tell you a lower rate, you will close. And they're hoping that you don't read the fine print or that you don't notice where your money is being spent. So eyes wide open. If you ever want us to look at a loan summary, I'm happy to. I'm licensed in 48 states, so everywhere but Utah and Rhode Island, I can look at it and be like, yeah, this is good, or no, it's not. But I cannot stress this enough. If a lender is pushing you to buy a lot of points, you have to ask why. Are their rates high to start off with? Do they need you to buy those points in order to be competitive? Is that the only way you'll qualify because they're maxing you to such a level that you have to buy down the rate? What is really going on? Are they just trying to get an easy sale by baiting you with a low rate? So a lot to consider there. Questions, comments, as always, feel free to reach out. Thanks for watching.